Stablecoins, the digital dollars of the crypto world, have exploded in value, surging from just $20 billion to more than $250 billion in 5 years. That's a staggering 1,100% increase. Driving this growth are two key forces: clearer regulations and the rapid rise of decentralized finance, or DeFi. The real turning point came in May 2025 when the US Senate passed the Genius Act, the first federal law requiring all stablecoins to be backed at a ratio of 1-to-1 by US dollars or highly liquid treasury securities. On the surface, it's a move for stability and transparency, but dig deeper and a bigger strategy emerges. Washington sees stablecoins not just as a digital upgrade to money, but as powerful tools to cement the dollar's global dominance and quietly help manage America's mounting debt.
We are going to keep the U.S. the dominant reserve currency in the world, and we will use stablecoins to do that. We believe that the United States should be the premier destination for digital assets.
In short, dollar-backed stablecoins are emerging as a powerful tool to reinforce US dollar supremacy in the digital age, embedding the greenback into global crypto transactions. The numbers speak volumes. The stablecoin market has soared past $250 billion, with an overwhelming 99% of tokens pegged to the US dollar. In 2024 alone, stablecoin transactions totaled $27.6 trillion, dwarfing the economies of entire nations. Broad adoption of US dollar-backed stablecoins could even reverse de-dollarization, says Barbara C. Matthews of the Atlantic Council. Even Federal Reserve Governor Christopher Waller concedes that stablecoins are likely to propagate the dollar status as a reserve currency. In addition to maintaining the dominance of the US dollar, stablecoins are also expected to become an unprecedented scale of US Treasury bonds, looking for new financial owners. As White House crypto advisor David Sachs put it, the strategy is simple: push stablecoins to boost demand for US debt. Standard Chartered Bank's report predicts that the size of the stablecoin market could surge by about tenfold to $2 trillion within the next 3 years, bringing an additional $1.6 trillion in demand for the purchase of US short-term Treasury bonds. In recent years, the international status of the US dollar has continued to be challenged. Back in 2000, more than 70% of global foreign exchange reserves were held in US dollar assets. By 2022, that number had slipped into the low 50% range, a steep decline in the dollar's share of global trust. In the commodities market, where energy transactions are increasingly priced in non-USD currencies, Russia, the world's second-largest exporter of oil, is selling its petroleum exports in the local currencies of its customers. Other producers might find themselves following suit, said Natasha Kaneva, head of global commodity strategy at JP Morgan. Against the backdrop of downward pressure on the US dollar index, stablecoins are seen as a shot in the arm, enough to absorb all new short-term Treasury issuance during the remainder of Trump's second term. The ambition? Nothing less than turning stablecoin issuers into the world's biggest buyers of US debt. By 2030, Republican Senator Bill Hagerty predicted that stablecoin issuers will become the world's largest holders of US treasuries. The trend is already underway, with more than $150 billion in treasuries. Stablecoin issuers now rank among the top 20 holders of US government debt, on par with entire national economies. What hidden risks do stablecoins pose to the financial system? Stablecoins have quietly become key financiers of the US government, funneling billions into treasuries. Yet that treasury-heavy reserve model is a double-edged sword. In a liquidity crunch, mass redemptions could force stablecoin issuers to dump bonds, triggering a sell-off that rattles debt markets. Regulators may eventually cap stablecoin issuers' treasury holdings, potentially weakening one of the dollar's strongest new pillars. The cracks are already visible. In the 2023 SVB crisis, $3.3 billion of USDC's reserves were trapped at the failing bank. The result? A swift depegging and a panic-driven sell-off, exposing the fragility of stablecoins tied to shaky banking infrastructure. Stablecoin issuers promise that holders can redeem their tokens one-to-one, but they aren't subject to the same rules as traditional banks. They have no capital reserves, no FDIC insurance, and no required liquidity ratios to protect against runs. A key concern raised by the Treasury Borrowing Advisory Committee, or TBAC, is whether stablecoins are simply shifting existing money around within the financial system or actually bringing new funds into US Treasury markets. The TBAC warned that about $6.6 trillion in US commercial bank transactional deposits could eventually move into stablecoins. If tokenized assets start replacing dollars held in banks, pulling funds out of the traditional banking system, these digital wallets could effectively become the new checking accounts. This shift would put significant pressure on bank valuations and reshape the banking landscape. Stablecoins are not merely a financial innovation, they are a strategic extension of US monetary power. They serve two critical functions: digitizing dollar dominance through borderless programmable currency, sustaining US debt markets via a compliant, globally distributed reserve mechanism. As the Genius Act unfolds, America is laying the foundation for a new form of monetary influence, not through interest rates or central bank diplomacy, but through code, regulation, and incentives embedded in digital assets. As the US pushes forward with stablecoins, can it preserve the dollar's dominance without introducing hidden risks to the global financial system?